All right, guys, this is being recorded. I mentioned this at the beginning of every single webinar. Watch this again, especially if you're newer to the way I teach. You know, you can go online and figure out how to do this spread. Yes, they aren't going to give you rules in order to implement this strategy, though. And that is the major difference. I have specific rules you need to follow in order to implement this strategy. Otherwise, there's other strategies out there that will work better for that given underlying, whether it be a long call spread or something like that, where you're playing a directional move. All right. So in this, we need high implied volatility, but there's other rules for other strategies. If it doesn't work if the underlying you have a directional move for, and this doesn't fit the rules for the ratio put spread, there's other ones out there. Trust me. Look at those. But watch this one again. It doesn't have to be this exact one on high volatility strategies. I drilled down more about volatility in this particular course. There's other ones, maybe if you're newer to options trading or something like that, you can watch one of the lessons where I really go into the details to make sure that the newer trader understands this specific strategy. So you can watch other ones that are the ratio put spread in order to get the gist of this. But I would suggest watching this one again, because some of the nuances will fly by you. And when you watch it again, you'll be like, all right, there we go. I got it now. All right, let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or Wall Street Journal for commentary on everything from economic to geopolitical and market analysis. I've been trading about 25 years now. Started trading in college after graduating from college with a finance degree. I moved up to Chicago. Started out as one of these runners down here, moved up into the pits and started trading. Been trading my own money that entire time. I've traded stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. Let me get this disclaimer out of the way real quick. It says any opinion, news, research, and analysis or other information provided by ProTrader Strategies and or associated companies or employees is provided as general commentary. You guys, we're here actually to teach you guys these specific strategies. I'm not here to give you investment advice. I can't give you investment advice because I don't know what's in your portfolio and I don't know what your risk parameters are. That is why. There's no other reason. Why do I teach this stuff? Somebody is asking then, you know, the reason why I'm teaching you guys how to trade is because it's, you know, it's kind of selfish of me in a sense, because I want tighter markets in these options montages. I want better markets. And if we all understand options trading better, we will make better markets. Okay. So that's what it all comes down to. You and I can have completely different, market assumptions on, say, Tesla or the S&P, where it's going to go. But the rules for trading options remain the same, okay? So, you know, we may bump heads on our directional moves. That's why I'm not giving you advice on investments, because your assumption may be right and mine might be wrong, right? All right, so you can follow me on Twitter at Wolfman's blog. I tweet out a lot of my trades, what I'm doing, if I've done them after. I do daily market commentaries in the morning where I talk about all my trades, when I put them on, when I take them off, whether they're winners or losers. I don't cherry pick. I just tell you every single trade I do. And then if I do something in the afternoon, I'm going to throw it out on Twitter just so you guys that are following along can stay up to date on what I'm doing. You know, like last night, yesterday, right after the daily market commentary, I put on some GLD and took off some Twillo. I tweeted that stuff out. So actually, I forgot to tweet out the GLD, but I did tweet out the Twillo. But in the daily market commentaries, I also said I was going to do the GLD. All right. So you can follow along with that. I'm not going to cherry pick. I'm going to talk about everything. And from ProTrader Strategy, you can get all kinds of market wisdom. Hopefully, you're getting market wisdom from me, but it could be mostly snark. All right. Like I mentioned, this is on the ratio put spreads. Now, usually when you set up this strategy, we're going to be setting up like a long put spread by buying one at the money or in the money and then selling a slightly further out of the money put to help finance that spread a little bit. But with this one, we're going to be selling 2, all right? And it's a 2-by-1 put spread or a front ratio spread. Yes, we found this out on last Thursday that TD Ameritrade puts this in as a front or as a back ratio spread, which is incorrect. A back ratio spread would be buying 2 and selling 1. This is selling 2 and buying 1, all right? All right, so what we need for a market assumption is to be bearish. That's really what we want. But if we are neutral, or even if we are directionally wrong, we can still make money when we build this out the way that I have for my rules. Now, if you guys watched last week's, or I know a lot of you guys I can see were guys and gals that were on last week's webinar. I ended up doing one of our examples the next day in the daily market commentary. I talked about it. I'm completely directionally wrong on that, but it is a winner because of that collection that I was able to get by building it out the way that I talk about, such as when we're doing this, we need to do this for at least a scratch, if not a credit. I prefer a credit personally. As a matter of fact, I went to the wrong one. I kind of backed up rather than going forward. So let's go forward. So the front ratio put spread is buying 1 out of the money or at the money. I prefer to go a strike out of the money myself. And then selling 2 further out of the money puts to finance the entire spread. All right. So we need to do this for at least a credit. Or a scratch works, but I like to get a little bit of a credit to help cover some of those commissions and everything else. I like to do it for free or for a credit, all right? And like I said, break even or getting a credit. Now, when we do this just slightly, the way I'm talking about it, slightly out of the money and then selling those 2 further out of the money put spreads, that puts our entire break even all the way out to basically where a 1 standard deviation move is. All right, so that's a nice big area to be wrong. I mean, basically we have from where it's trading right now to a 16% probability of losing. Only a 16% probability of really losing on this strategy if we write it out to the expiration. All right, so essentials to success is having the right environment. First thing we need to know, what's the right environment for a ratio put spread? We need high implied volatility. I don't care about the VIX or the VXX. I don't care about a derivative of a derivative of a derivative. I care about a derivative of a derivative, not a derivative of a derivative of a derivative, all the way down, which is what the VXX is. But it's a slippery slope. So the right environment for this is implied volatility percent. When I'm talking about implied volatility percent, I'm talking about for each individual underlying has a different implied volatility. And what we're looking for is where that current implied volatility for that specific underlying is in relation to where it's been in the past. Now, yeah, you could say you're looking at a little bit of hindsight, but what happens is, stocks have a tendency to trade in a range, like, Facebook doesn't run up to 1,000 or down to 0. Well, the volatility for these underlyings really has a range, and it's specific to that particular underlying. Where, let's say, tech stocks might be up in the 40s for their implied volatility, and a utility might be down in the teens or maybe closer to 20. And that might be high for 40 might be high for a tech stock, and 20 might be low, whereas for that utility, 20 might be very high. Okay, so we need to make sure we're comparing apples to apples. So when we're looking at a specific underlying, we're looking at its implied volatility in relation to itself, not something else. Okay, that needs to be specific for itself. All right, so we need high implied volatility percent for the right environment. And what we're going to be looking at, I'll just pull up a platform real quick, hopefully, if I can get my platform on the right screen. Sorry. So let's go over here. So implied volatility for SPY is 14. Now, to find out where its implied volatility percent is, basically where it is right now into relationship into relation to where it's been in the past. We take the numerator, the sum in the numerator, and divide it by the sum in the denominator. And in the numerator, we take 14 minus the low. So we take where it currently is minus the low and come up with that sum and divide it by the high minus the low. So right now the current is 14. Well, let's call it 15, round it up to 15. And then go down here, 15 minus 10 in the numerator is 5. So we take 5 and divide it by the sum of the high minus the low, which is 32 minus 10, so 22 in the denominator, right? So in the numerator, we came up with a sum of 5 divided by 22. 5 divided by 22 is somewhere around a, what is that, a 15% area. Another place you can find it is right over here in the option montage. So the current implied volatility percent is 20. All right, I was close. I was doing the math in my head, and I probably should have come up with 20. 5 goes into pretty easy. It was a quarter of it, right around there. So 20 IV percent. So what we want to do with this strategy, though, for the right implied vol or for the right environment, a stock needs to have that percentage above 50 for an ETF like that one we just saw, SPY. It needs to be above 30, which we could see it was at 20. That wouldn't really fit for this particular strategy. Although I would like to play SPY to the downside after today's economic data and market action. But for this stock, we want implied volatility percent above 50 for that underlying. And if it's an ETF, then we lower that. It's got to be above 30. Now, picking the right underlying. We can pick any stock, right, to trade options as long as they have this option montage. This page is the option montage where it's got all of the different months and all of the breakdown of stuff inside of here. That's what we're looking for. So picking the right underlying, what we need to do is go to the monthlies, which is probably this March, 22 days to expiration. It has the most volume and open interest. If we kind of flipped over to this and just went volume and open interest, you can see there is probably a lot more volume and open interest going on here than way back here. All right. There's still some pretty good open interest, but you can see the volume starting to slough off a little bit. So we want to pick this one. And picking the right environment, a stock over, or picking the right underlying, the stock that's over $100, what we do is take this decimal, move it 3 ticks to the left, and say 27 cents is how wide the bid offer should, inside of 25 cents is how wide these should be. So if we were to look at another stock, $100 stock, move it 3 decimal places to the left, 10 cents wide is how wide these should be. And you can see on the option montage that's closest to expiration, the monthlies, you can see that fits this rule. All right. Any stock under $100, basically 10 cents wide is the rule of thumb. So this should be inside or tighter than 10 cents wide for the majority of these. Every once in a while, we'll see them get a little bit wider, but know that right now we are also talking about this product after the market's closed. So a lot of orders have been canceled. It will have a tendency to widen out just a little bit. So during open market operations, a stock under $100 needs to be 10 cents wide or tighter. Any stock over $100, it needs to move. We need to move the decimal place 3 ticks to the left, and 40 cents wide is where this option montage should set up for the majority of these underlyings. Okay, during open market operations. All right, so 40 cents wide, it should be tighter than that for us to trade. And the reason why is we want a lot of participation. We don't want all this guesswork, right? One of the things that I try to teach you guys, for one, is take the guesswork out of whether or not I should be implementing this strategy. I don't want you guys having to second guess yourself. You should be able to go through these steps and say definitively, yes, this is an appropriate strategy for my market assumption in this underlying. No doubts about it, okay? That's what I want you guys to go into this knowing, confidence, and when you're more confident, you're going to make better decisions, all right? So that's what I'm trying to do here is take the mystique away from this. And if you're trading something like, you know, Aon or what's the other one that's Biogen. Biogen used to have pretty good markets. And in this one, I would say move the decimal 3 ticks to the left, 30 cents wide is what the bid offer should be. And you can see this does not even come close to fitting this. Stay away from it. Look how little volume and open interest there is. Almost nothing. Stay away. Why? Because you have to give up so much edge to get in. I might have to go all the way down to $8 and be giving up a major edge on this. If you don't understand pricing on options thoroughly, stay away from this because you are going to get eaten alive by the one guy in Biogen that's making markets, okay? He's not giving up very much edge because he's probably not even watching this one. He's more interested in Apple or something like that. So he's going to make them really wide and make you come to him, all right? So tight bid offer is what we're looking for in this particular situation. And Biogen would not fit. Picking the right duration. What we're doing here is we are selling premium, all right? We're collecting a credit here. Anytime you collect a credit, no matter what strategy it is, you want theta decay because that theta decay eats away at that premium you sold and then the premium starts going down. If the premium goes down when you sold it first, you're selling high and buying low. That's what we want. The right duration with the fastest theta decay is going to be inside of 35 days to expiration, all right? That's what we're trying to take advantage of. Get in to 35 days to expiration or as close to that as we can, right? If it's 20 days here and 45 days out here, I would lean towards going a little further out in duration because you're going to be able to collect a little bit more credit. I don't ride it all the way out into those last 7 days if at all possible either. So that's another reason why I want to get further out on the curve so I can get out here. There's a lot of other risks that go on here. Big money likes to push stocks around to places where you don't want them. Also, there's gamma risk, so smaller moves will negatively and or positively affect you. Seems to be more negative in my eyes when you get inside of this, but I want to get out somewhere in here before it starts getting into the funny business over here. So if it's trading around 20 days to expiration, 35 days to expiration, you know, it's 15 days, 45 is probably where I'm going to go to. All right. So I'll default further out in time than default further into time on these strategies. Okay. So we want this theta decay to happen whenever we are selling premium. And in this one, because we've got that extra short put in there, we are going to be a premium selling strategy. And we want that theta decay. Picking the right strikes. I've mentioned this before. We want to build this out so we get a credit. All right. You can do it for a scratch, but preferring a credit. If you do it for a scratch, you're going pretty far out of the money on this particular strategy. So you'll be able to build it out to where you're probably further than one standard deviation move if you're following my rules, being in a high volatility environment. But what we want to do is build this out so that we get a credit or a scratch. And usually it's going to be picking that one option, that option strike that is just a strike out of the money, and then going basically one more strike out of the money in order to sell those two puts. Now, another rule of thumb to look at this for this is if it's a stock under $50, you're going to be looking at a spread that's about 50 cents wide. Therefore, I would lean to the stocks that are over $50, you guys. You just won't be able to collect enough of a credit to make it really worth it. Some of those commission costs are probably going to eat into your credit and almost make it feel like a debit at that point. But if it's less than $50 wide, you're going to be looking at 50-cent wide spreads. If it's a $50 to $100 stock, we're going to be looking at about $1 wide. And any stocks over $100, you're going to be going from $5. If it's $200, it's probably a $200 stock. You're going to be looking at about $10 wide, and you can kind of scale it up in the hundreds from there. Okay. But I like the ones that are around the $100 stocks for this one to get the best bang for your buck, it seems like. All right. So picking the right strikes. We want to build this out so that all of the credit we get with the spread and everything else, we are at a 1 standard deviation move. And I'll show you how we build that all out here in a minute. But we're going to try and build it out so we're at 1 standard deviation move. And knowing our exit strategy before entering our trade. All of these rules, when you build this out, you've got a particular underlying. You're thinking you want to play to the downside, right? It's going to go down to an area. Maybe it's a Fibonacci or something like that. And that's your assumption. All right. We go through the essentials to success. Write all of those things down. The right environment. What is the stock? You put that down. The date. What date did we come up with this? What's the right environment? What's my thesis for my assumption? Put that in there as well. Picking the right underlying, that's the underlying we're going to write down. Okay, yeah, it fits that rule. What's the duration? Write down your month, how many days to expiration you entered this at, and picking the right strikes. What strikes you pick, why you pick those strikes. Maybe it's you went 2 ticks out of the money rather than just 1 tick out of the money, and write down why you picked that, okay? And what your credit was, all of that stuff. And then finally, when it's all said and done, write down what your exit strategy is. My exit strategy for this one is when the position reaches a 30 or 50% increase in profit. All right. So in a sense, or 50% of the max profit potential. I'm sorry if I said that incorrectly. We're looking for 30 to 50% of the max profit potential. So if it's a $5 wide and we collect $1, our total max profit is going to be $6 on it. And I'll go into that here in a minute once I throw this screen up. So it's the long strike minus, it's the width of the spread plus the credit we receive. Remember, I said I want to get a credit for this strategy. We're getting a credit plus the width of the spread. If we are looking at $100 underlying and I'm doing $5 wide, we got that $5 width of the spread plus the dollar we collected. $6 is our max profit. I'm looking to get somewhere between 30 and 50% of that. So if it's trading around $3, I'm out. All right. And I'm writing that down. You know, if I'm not as sure of it, maybe I'm saying I only want to try and get about 30% on this one. It's the first time I've ever done this strategy. Write that down. My 30% increase is this, and stick to it. Once you get to that 30% increase, you wrote it down, get out. Don't sit there and go, well, Wolfman said somewhere between 30 and 50%. And I wasn't really sure when I got into this, and that's why I did 30%. But I'm going to go for the 50%. Don't do that. Don't change your strategy midway through or when you're at the goal line, all right? Stick with it. You got to stay mechanical. If you stay mechanical and you constantly do that, you will be more confident, you guys. You will be able to sleep at night. But when you start second guessing what you've come up with and squeezing more out of it down the line, then that's where it's going to come back to haunt you, all right? So stick with what you've done, or stick with your strategy from inception, all right? And don't change it. You know, later on, once you get used to this, you'll start saying, well, the next time I do it, I'm going to go for 40% increase, all right, or 40% of my max profit, all right? And then stick with that. Get up to that 50% when you have the risk tolerance appropriate for that. All right, and our max loss is our short strike minus the max profit, because remember, we're playing this to the downside. And then our max loss goes to 0 if the stock were to go to 0, all right? So what we need to do is figure out what the width of our spread is, that total collection, our max profit. So in this case, we were looking at $100 underlying. So let's just say that I did the 95, I bought the 95 puts, sold 2 of the 90 puts. That's $5 wide, and I collected $1. My total max profit would be $6 on this, but our max loss goes to 0. Our break even, we take that original credit, we take that short strike minus the width of the spread minus our max profit. So it actually should just be minus our max profit here. I don't know why it's the width of the spread. Our max profit is the width of the spread plus the credit. So it's actually just the short strike minus the width of, sorry, it's getting at me. I'm trying to write on this and it's not letting me. It's the short strike. Why won't you write on here? My pen. Get rid of this. It's just basically the short strike minus the max profit. So in that example where we were talking about the 95-90 put spread where we sold 2 of the 90s, our total credit was $6. Then our break even is going to be when this underlying is trading around $84, right? Because that's a $6 down. And I'm going to go through this right now to kind of clean this up, make sure we are all clear of concept. All right. I'll pull it up on the Analyze tab. I think I forgot to pull this up on the Analyze tab last time from playing this out. And let's just go with an easy example, the same one that I had last week, because I actually am really considering putting this strategy on. You can see this is the one that I put on from last week. It's the 1x2. I'm long one of the 115 calls, and I'm short 2 of the 120 calls. All right. I collected 36-cent credit on this, I think, off the top of my head. It's a scratch right now, or very close to it. The market, completely directionally wrong. I thought this would go up and it was going to go closer to the 120s. I think that was because there was a there was a Fibonacci up in and around there. So I thought maybe we would go up there and settle down with the total credit. It wasn't going to be too far off. So I was actually looking for it to migrate that way. Market corrected. This was all about that Apex Legends game and versus Fortnite. If you guys follow me on Twitter, I've been talking about this for quite some time now, basically since they had their earnings. But Apex Legends has kind of fizzled out. It's starting to turn around. That's why I kind of want to get into this as a put spread to the downside. I think it's probably going to come down. It could come as close to where they came out with their earnings. They didn't come out with very good earnings. Then everybody started talking about Apex Legends. We got the rally. I think it might go back down there. All right. So let's come up with a perfect example here, hopefully. So $96, it's a stock under $100. I look at the bid offer in the option montage, and EA Sports usually fits this rule, but make sure during open market operations, you see it as well. I'm going to go with that it is fitting that rule for being the right underlying. Is it the right implied volatility percent? I said anything above 50 is good to go. So we've got the right environment. We've got the right underlying, I'm saying, even though it doesn't look like it right now, but during open market operations, it does. And then we are looking at whether or not it is the right duration. So 22 days to expiration. Remember when I was looking at that expiration, the theta decay? 22 days is like right here. We're halfway through this big drop. 50% of the drop happened. 50% of the theta decay happens right in here. We're about halfway through that. That's another reason why I don't like going this close, because it's kind of pushing me into having to take it inside that 7 days. So I'm going to roll out a little bit further in time on this. Gene, I see your question coming up. Let me give me a second to kind of read over it while I'm thinking of this other stuff. So I'm going to, this is where we look at to see if it's the right underlying, but it doesn't preclude us from going further out. If you go further out in time and it fit my rule inside here during open market, why is that so hard for me to say? Open market operations. But you can go out here. This volume and open interest is currently starting to roll out further in time. This is becoming the spot month. Right now, this is a spot month. That means that's the one that everybody is trading. This is quickly becoming the spot month, and the markets will start becoming tighter. All right. as more and more people pile in here. Because with this volume and open interest, what really happens is the more people, like I mentioned with the other guy, there's one guy in town. He's the only guy making markets, and he might not even be watching his markets. All right. He's the only cat in town. He made a market and he leaves. He just says, you got to come to me. Whereas over here in EA Sports or Apple or some of the tighter ones, you know, if I'm the $2.95 bid and you come in here, all right, well, I'm $3 bid. All of a sudden I think, you know what, I'm going to better my bid because I want to be on the market. I want to be the guy that gets the trade. So I move it, you know, maybe a penny higher than where you were to get on the market. So that all of a sudden now it's only 4 cents wide where it was just a minute ago 10 cents wide. So that's what happens when more eyeballs are in here. We're all fighting each other to make better markets. And the thing, then this option montage gets tighter. That's what I talked about at the very beginning of this webinar, you guys. Remember, I want tighter markets. I want Aon. I want Biogen to have tighter markets. You know, we saw Biogen has massively wide markets. If everybody learns to trade options, we don't have to have the same market assumption in order to make tighter markets. Okay, and that's what it all boils down to here. So let's look at EA Sports for an example to the downside, because it actually still has high implied volatility. One rule I want to make sure that I touch upon that isn't really mentioned so far with the slides is that we don't want to do this in and around a earnings strategy. We don't, or an earnings event, you know, down the road, like next month, let's say, if it was falling into the, in March or something like that, if there was an earnings event in March, we wouldn't want to set this up now for that because we are selling premium, right? We want that volatility to come out with that theta. As volatility comes out, the premiums come out quickly as well. So we want premiums to come out of our strategy. We do not want volatility to go up. That pushes premium back into them. And when there's a binary event, we would expect volatility to increase. We just want volatility to come out as we are in this trade. So there's no earnings event. We're good. All right. I have specific rules for earnings, you guys. So if you guys want to know how to trade in and around earnings, you're going to need to watch those because it's different rules. All right. Slightly different rules. All right. So EA Sports, we've got that. And picking the right strikes. I talked about this. I like to go, I would say the 96, it's trading 96. The 95 is out of the money. I like to go, but I could also say that's the at the money. So I'm going to go a little bit further out. I like to go one tick further if I can, which gets me to the 90 strike. So I take the 90s and then I'm going to look to sell the 85s twice. Look at that. I get a 48-cent credit, right? 48-cent credit. That means if the underlying starts trading down here and pins on the 85, or sorry, yeah, on the 85s, I'm basically going to be able to have that full credit, okay? But if this happens in, say, the next 20 days, it comes down and hits this 85, you guys are going to be very close, if not past that 50% of max profit, okay? And then you'll cover it. Because we've got that extra short strike in there, people are going to be wondering, oh my God, I don't want that downside risk, Wolfman. Well, if it comes down and tests you on this 85 strike, know that you are going to be at 50% of your max profit at that point. Another thing I want to switch to is this delta aspect. Remember when we were talking about this, one standard deviation move in the underlying is a 16 delta. We've gone over this time and time again, right? If I take up all these percentage points to the left of -1, that's one standard deviation move. That puts us at around a 16 delta, all right? It's a 16% probability of being in the money. So if I take this, remember, and I take the 90 and the 85, I get that full width. So that's $5 plus the 48-cent credit. That means my break even is at $79.52 because I've taken $5 plus a 48-cent credit, subtracted it from the 80 strike, which is the one that I'm short, the 85 strike, subtract it from the 85 strike. So I got the $5 plus the 48 cents. That puts me down there at 79.80 or 79.52. All right, so that's my break even. And you can see that that's an 11 delta, which is outside of a 1 standard deviation move. When we were looking at the bell curve here, this is a 16 delta. We're looking at about an 11 delta, which is going to probably land somewhere right in here. Okay, because if we take half of this percentage, which is about 4.5 plus that puts us about 9, so close to 10 plus the 1. We're at about an 11 delta right there. So we're outside of that 1 standard deviation move with all of our credits. Okay. Now I'm going to try and get to a couple of these questions real quick, so bear with me. I'm a terrible reader, but I'll try and get it out here for you guys. All right. E, you speak of liquidity and small spreads and price ranges. Have you found a quick shortcut using average daily volume that usually fits all these criteria? Gene, there's not. Because even something like Biogen or Aon, everybody's heard of those stocks, but not a lot of people like to trade the options in there. And to be honest, I don't know why. It's not that they're any more volatile. They just aren't sexy names is the only thing I can come up with for that. But the volume up here doesn't necessarily correlate to the volume in open interest down here, because like Aon probably has quite a bit of volume on the stock. So it's not always, no, maybe not. It's not always a direct correlation with the volume here and the tight markets here. It's a closer correlation because obviously more participants in the underlying are going to be interested in, a percentage of those will be interested in the options, but it's not a direct correlation with that, to be honest. So it's really has to do with just, you have to go in here and look at it. And if you get these tight, if it follows that rule, you move it 3 ticks to the left and it's inside of that, you can rest assured that that's a good market. Okay. Would you use these ratio put or call strategy before earnings with the highest ID and buy the option with the expiration week after the earnings announcement? I really don't like the spread on earnings. And the reason why I would just rather use something, I lean towards the naked strategies for that. You got a higher probability. I'm selling the premium where this break even is in a sense. So, I'd rather go for that. If you are believing that more times than not, and it is true, it happens, that it's going to stay inside the expected range of the market maker move. This is the market maker move for a particular underlying for earnings. And you think it's going to stay inside of that, then, that's going to be on you guys. I just don't like to do this one for earnings. What about doing the trade 1 day before earnings to collect the Vega compression and theta decay? Daniel, back on that, you can do this. Set it up the day before earnings, and you can do that for sure. I have no problem with that. I just don't have a tendency to default to this one for earnings. This is the only thing I can say. I just generally go with other strategies. And it's not because I don't love this one for earnings. It's just I usually go with just selling the naked premium strategies. But I have a pretty high risk tolerance. Somebody's asking about this won't work in an IRA. No. So the one thing is you kind of create, and look, this is where it says back ratio spread, they're wrong. What we do with this is we bought let me go back to my EA Sports. Actually, let me first check this on the Analyze tab for you guys, because I know we didn't do this on the last webinar, so I want to make sure I cover it on this one to check out on the Analyze tab. You know what? It's going to show my other strategy in there too, so let me just take out those on this. strategy. All right. So, and delete the one from last week, which was the call one that I ended up doing. All right. So with this, you can see that the back ratio spread, if the market goes higher and we're directionally wrong, we get to keep that 48 cents, which is kind of what happened with this strategy. When it directionally went against me, I got to keep that premium I collected. But as you can see, when the market starts trading down, we get our break even down there at 47. This says 90, but that's wrong. Or 97.90. I don't know why this is looking like this. Oh, that's where we start getting our profit. So we're trading right here. We start going down to the trade, or on our trade, we're starting to lose money as the market goes. Why is this? This is not right. I'm not looking at the Analyze tab right because it's got some of the other stuff in there. Why is the Analyze tab showing as the market goes down, we are losing money? It should be showing making money. It must be pulling something in, or I'm not able to think fast enough to figure that problem out while I'm trying to walk through this. Oh, wrong. Date is wrong. Date is wrong. On the Analyze, what date? This one? Oh, here. That's why. Today. Thank you. Today is the 21st. All right. That's still not making it right. I should be making money on the downside here. As the market goes down, that's what I make money. Oh, I know why. Because I'm looking at it from the 85s. If the underlying is currently trading, where is he? 95. This is going to drive me nuts, you guys. I'm sorry. So the underlying is trading around 96. So we're trading right here at 96. So on the upside, we get to keep that credit. On the downside, we are, you guys, all the way to basically 85. That's our max profit. All the way down to 80 is where we should be seeing our break even. And for the life of me right now, while I'm on the hot seat, I can't figure out why it's not. Drag the slide on the graph like that. Still making a, oh, you're brilliant. Because I was looking at the purple, wasn't I? Thank you. Oh my God. Choke fest over here, you guys. So thank you guys. So here's where we are right now. If it continues higher, we get to keep that premium. If it continues lower, we get to keep that premium. We start making money when we hit our 90 strike. And because I was a potato a minute ago, I couldn't figure this out. But you can see right here at the 85 strike is going to be where our max profit potential, that should come up to a real tight point. And then it's going to start eating away as we start going down. That extra short put starts taking away some of our profit, but we get all the way down to the 79.52 is where our break even is. But the blue is what we should have been looking at. The purple is basically what you would be losing on the underlying on that. Happens to all of us, Amaro says. I dragged the slide. Everybody was blowing me up during that. You guys, if I should turn the camera on and see how red my face is, it'd probably match my red shirt right now. I'm so embarrassed. All right. So a couple of things I want to talk about real quick before we run out of time. This is a good setup. Now, remember, we went another tick out of the money, right? This fits our rules. We can look at another one. Let's look at Microsoft, because Microsoft has low implied volatility percent right now. We can scroll this all the way down and see its implied volatility percent is 12. So we go over to the charts, we look at it. We could have done the math. Current implied volatility is 20. The low right down here is 16. So you got 4 in the numerator, the high being 50 minus the low, which is 15. So you've got 35 in the denominator. Divide those two to get 12. All right, but look, we can look at this. 20 is where Microsoft is currently. We look at EA Sport, where is it? it's at 40, but you can see the range is very similar. They're both tech stocks. So why is it important to have the high implied volatility percent for this particular underlying? Well, let's go look at the strategy. We looked at EA Sport. We were able to go down to 90. But in Microsoft, if we look at its strategy, it's trading a little bit higher, $10, right? But the other one, we were able to go 2 ticks out of the money. This is the first one. Buy that one, sell two, $10 or $5 wide like the other one. We were able to get a credit as well. But this strike is only $4 away, whereas our other one, we were like $6 away at least. And then for the first strike out of the money, I went all the way out to almost, $6 out of the money on that one, further than this as well, right? Only a credit. If I go 2 ticks out of the money, it's never going to work on that $5 wide. I'm doing it for a debit, okay? So you can see the premiums slightly out of the money for this one are much less. It's a tighter market. We're not able to get as far away, whereas EA Sports, we are able to get a full $6 away and get a nice big wide strategy. And we could even go further out and hit this one by the 85s, sell 2 of the 90s, and it'll still work out for a credit. Yes, but EA Sports can move faster than Microsoft. Well, that's what the market is predicting with volatility. But no, I mean, they both have the same capability of moving, right? I mean, EA Sports is seeing more volatility right now because of this Apex Legends stuff and missing on earnings, but they're both tech stocks and both can move just as wildly as the other, depending on their volatility. Right now, EA Sports expecting a bigger move because of the volatility. And that's what we want. We want somebody to be expecting a big move because usually volatility is overstated, you guys. Volatility is a fear indicator in a sense. Some people would debate that. I'll debate that with you all day long. I believe it's a fear indicator. Fear of upside or fear of downside, to be quite honest. And fear is usually overstated. So that's when fear is at its highest. That's when we come in and hold those people's hands for them. All right. We're doing them a favor. So that's what I'm looking for this. All right. You can get a lot further out of the money. You can see when I was selling this one, I'm able to get all the way out to about an 11 delta. What was Microsoft getting us to? Microsoft is probably closer to the same delta, but they're going to be a lot tighter. 1 tick out of the money, we're looking at $4 lower here and selling 2 of those. That's going to get us very close to around that 7 delta. So it's getting us further out on the deltas, but that's because the deltas get a lot closer to get smaller, closer to at the money on very low implied volatility stocks. All right. Did you say that at the beginning that this is a standalone spread, or this is the extra, or is this helping to finance another spread? No, what I was trying to convey there, let's go back to the good example, EA Sports is, delete this. So what I was trying to preface here is this is the long put spread, right? But when we sell, and in a long put spread, we do this in a low implied volatility environment, not a high implied volatility environment. But when we get that high implied volatility, we go in, we sell that extra one, that extra 85 put I just sold finances this spread. And back to the question somebody was mentioning about an IRA. If you're trading in an IRA, what we do is we make it into a broken wing butterfly and go out to the first option I can buy for a nickel, which might be the 61 or it might be the 55s. All right. That defines the risk, makes it appropriate for an IRA. do not take that kind of risk going in there and hold solace in thinking this is going to be a strategy that will come back from this kind of move. I would be looking to get out as soon as it's going below my break even on this particular strategy. Okay, on a loser. All right, so that's where I would be looking to get out there. Did I answer you guys' questions? Somebody said try selling the 2 and then buying the 1. Does that make it selling the 2? I get the 2 in there and then buying the 1. Does it make it still comes up as a back ratio spread? They don't have it in there correctly for that. But that's why we wanted to do this in high implied volatility. All right. You guys have any other questions? Gene, did I answer your question right? And I got to the 1 for the other, right? All right, guys. Our deal is buy 1, get 1 for the same price. Buy 1, get 1 free in a sense. But basically, normally we charge $4.97. Basically, right now we're giving you these 2 for the $4.97. Buy 1, get 1. It's basically over 40 hours of content here. The hacks will streamline your process. Volatility Crush will let you sleep at night. You guys should be confident enough to trade in just about any type of environment after going through all these. This streamlining your process is going to save you all kinds of time and headache trying to figure all this stuff out, going through the math, pulling up your calculator, doing all this stuff. I have little hacks to kind of help you through all that. You'll be able to glance at something and know the probabilities of a particular occurrence happening. And then in the Volatility Crush, I go really into detail about volatility. I only kind of touched on it a little bit in here. I did drill down on it a little bit, but this is a major Volatility Crush course. This link is in the chat window. All right, I don't have a link on this page. Normally, if you guys are watching this on tape delay, you can pause it and punch this into a URL. For you guys watching it, the easiest way to do is click on that link. It's a great deal, all kinds of content. We've also built this out where you can check off every webinar that you've watched. So you don't, if you're skipping around and said, I want to go and look over at, how the wrong indicators to look at or something like that right away. You can check that off so when you start going back through, you don't have to watch that one again or realize that you watched that again, all right? So for $4.97, you get both of these and you have as much time as you want to go through those, okay? If you come back in a month, you go on vacation, you live in Europe and you get a month vacation, then you can come back and start watching these again and start checking those off the list, all right? So take advantage of this, guys. It is a great course. The hacks, I can't tell you, you're going to probably save hours out of the day. You'll be able to look at all these Greeks and know different things about them in order to make new assumptions. And then the volatility, which is the most important thing, I think, when trading options in this course here. So 2 of the best courses we have to offer for the price of 1. You guys can't beat it for that. Great webinar, Eric, as usual. Thanks for the great information. Looking forward to next week. Thanks, guys. Appreciate it. I'll leave you guys with this page here so you can stop and punch this into your URL if you're watching it on tape delay. And finally, I just want to thank you guys all for participating in later webinars. I'm going to be drilling down on different option components, how I trade options, and when and where I find those trades appropriate. Again, there's that link. Thank you guys for watching. And if you guys have any questions, you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. Take advantage of that. That's the link, like I said. And I'll get to a couple of questions I saw pop up late here before we get out of here. Since you recommended the ratio spread over 35 days, it seems to me the way you make money is not from the theta decay or from the delta move, but from delta and vega. Yes, theta, and you know what, Daniel, I mentioned that more in the last one, and I'm sorry for those who watched this one and missed out on that. But you're right. As a matter of fact, I'm glad you brought that up because I talked about this. You can see for every percentage point that comes out, and we can look at EA Sport and see that from basically yesterday to today, it was 44. To today, it's 41. So 3 percentage points came out of this today alone. So 3 percentage points came out on the Vega side. We can look at Vega. So even if the underlying didn't move, basically 3 times 13, we've gotten almost 40 cents coming out of this today, even if the underlying didn't move. Whereas if you look at the theta component, we got 4 cents. So you're right, Daniel. You're absolutely right. And I'm so glad you brought that up because this is a volatility component. And when we have high implied volatility, more volatility can come out of this. We could go over and look at Microsoft, and that's another reason why not to play around with that, because usually Microsoft is going to have at that same strike level, only 10 cents coming out of it. All right. It says 15 cents there, but you are going to see volatility affect the higher ones. And volatility can, if there's a lot more volatility in there, it can come out quicker than when it's at its lows. What I was talking about with a range, just like a stock has its range, you can see volatility has a tendency to stay within a range. So, when it's way down here near the low, you can see it doesn't have a whole lot more to lose, okay? So you're not going to get those massive, 3, 5, 10 percentage points coming out of this strategy. So yes, it is more of a volatility play than a directional play, but all of those things obviously will help you. But yes, the Vega will help you the most until you start getting really close to expiration, and then that starts flipping a little bit, but we aren't going to be trading at that tight into the expiration. We're going to be trying to get out of that much earlier. But thank you, Daniel, for bringing up a great point, and reminding me to mention that to everybody. That's all I got for you guys. I hope you guys have a great weekend, because I probably won't talk to you other than if you're watching the daily market commentaries. And by the way, I called today's pullback in that market commentary. So check those out. Will help you out in trading. I can almost assure you. That's it, guys. And if you can't take that, take it easy. Take care, guys. Thanks, Andrew. Thanks, Daniel. Appreciate it, Ted. Take care, guys. Take care, JQ.